Good morning. Good morning, students. Hope you all are doing well, and I'm sure you all are studying with all your prowess. We are here to make a difference in our own lives and the lives of our friends, our parents, our near and dear ones, and the ones who really care for us. And students, this is the opportunity. This is the tool. ये वो हथियार है जिससे आप अपने और अपने सभी की लाइफ में एक बहुत बड़ा पॉजिटिव चेंज ला सकते हैं. एंड दैट इज वेयर यू हैव टू बी ऑलवेज on your mark. You cannot let your shoulders down. Whatever be the situation, it may happen that at times you may be very much pressurized with the portion. At times you may be frustrated with certain concepts, certain questions, certain answers, certain misanswers. But that is all part of the game. There is no battle which is won conveniently. At least if the battle is one which can create a big difference in your lives. Those battles are always fought on barefoot and on the grounds which are full of thorns, in gusty winds, and when there is dark around, when you cannot see any light of hope. But then in such adverse situations, when you hold your ground, when you keep fighting, when you keep your aim, your dream in mind, there is a dawn. There is the moment when you transform from a simple layman to the highest level respected professional called as a chartered accountant. But for this, today, you have to fight. You have to make out your ground, your position. You have to fight for your own self. You have to exceed your limits, the limits which you yourself have imposed. Many times students come and tell me, sir, I'm not very smart in studies. I'm not so-called scholar in studies. I've never scored outstanding. I am an average student. That's all okay. But always there is an opportunity to upgrade. There is an opportunity to transform. Okay, it may take time for some certain concepts, certain sums may be easy, like you're just clicking on some app. But at times it may be difficult, it may be challenging, but that is the beauty of the subjects, of the course, and of the level that you are expecting to command in future, in your family, in your society. So for that, you have to be always geared up. Even you feel down, buckle up yourself, push yourself. You have to motivate yourself. Nobody else can do that. All the other motivational things are external. Until unless you remind yourself of your big dream, of your goals, and most importantly, the purpose for which you are doing this course. You have to keep reminding and keep telling yourself that I will become a chartered accountant for sure. Right? So let me take you through this particular one of my most favorite topics and the most favorite part that we are going to discuss today in this topic. So yes, very good morning, Lakshmi, Ajay, Shamli, Ishwarya, Ashlesha, Neeraj, Tanisha, Tisha, yes, Nikhil, everyone, very good morning. So let me just run through whatever we have done. I have purposefully kept the markings so that you are aware of the previous whatever we have done. See, whenever we ourselves write down something, the retention is much more. It is your graphical memory. That is why whenever I'm studying anything, be it a subject or be it any notice or other, I always have this habit of writing on the printout. So whenever I'm going back, by looking at my own writings, at times scribblings, markings, I recall it much faster than if I plainly read it again. So develop this habit that whenever you are studying in your modules, you will keep writing whatever you have understood. Or in fact, wherever you have queries also, put your queries there. Because many times when you go back at the time of revision, that is the best start. And at times it happens that what query was not answered in the first round of study or reading gets answered in the second one, right? So we have this format. I call it as the reconciliation format through which we compute our PGBP head income. This format starts with your profit and loss account, net profit. So you have to keep in mind that this amount is made up of certain debits which have been subtracted, certain credits which have been added. So this is how this amount is made up. And with this amount, you are going to derive what should be the final income as per the PGBP head or the business head. So whatever is already debited in the profit and loss account, but your PGBP head says we do not consider them as our expenses, hence we do not allow them as a deduction. You have to add back because they are debited in P&L means they are already subtracted in P&L. On similar lines, whatever is credited in P&L means they are already added in this net profit. So these figures are additions in your net profit. Now, in case PGBP head provision says that no, these are not our incomes, they may be incomes of other heads, but they are not our incomes, and hence we cannot tax it under this head, then we subtract them. Then comes those items which are not there in P&L, but because of PGBP provisions, they have to be considered. Now, in that, there could be two items. First, those items which are your incomes, but not placed in the P&L credit side. It means they have not been added in this. But we consider them, PGBP consider them as taxable, hence you have to add it. On similar lines, those expenses which are not debited here, that is, they are not part of P&L, means they are not subtracted from this. But in PGBP, they are considered as expenses and allowed as deduction. So again, those expenses we will subtract. So we have add less on both sides. For expenses also there is add and less both. For incomes also there is add and less both. Just keep one thing in mind that we are starting with net profit figure in which already certain items are added, subtracted. That gives you an idea how to proceed. Now, for doing this reconciliation, there are two steps. Step one was segregation, which is simply identifying what all things will not be part of PGBP. So step one is segregation, where you identify those items which you feel sorry, not feel, which you know are not part of business head. They are non-business items. So those are the items which you have to segregate, means add or less, to nullify their effects from the P&L. Step 2, which is critical, which is important, is now apply these sections, the provisions of the PGBP head, to determine what all items are to be considered in PGBP at what values. So PGBP has provisions for both credit items, that is incomes, and for expenses that have to be considered while computing PGBP income. So you then apply these provisions of PGBP to determine what should be the final result. Now in this, you have provisions on the credit side that determines what will be income. So for that, you have section 28, 41, 43 CA. 28 is simple. It deals with the direct and indirect incomes arising out of your business. 41 is different. It deals with those amounts which are your past expenses or losses. So they are not income per se. They are in fact losses. They are expenses, but of earlier periods, and they have been allowed as deduction earlier. So in past periods to which these expenses belong, you have already debited them in the profit and loss of PGBP. That is, you have taken their deduction, you have adjusted them in past year's profits, and now this amount is recovered or reimbursed in the current year. So whatever expenses you consider is now recovered. Whatever losses you booked are now reimbursed. So it is like simply giving the counter effect. So you had debited something, it is returned back. So you credit to nullify the effect. That is how these items becomes income as per 41. And then as per 43CA, where you are dealing with land or building, immovable properties. Now there can be two possibilities. Either you are in the business of selling these immovable properties, then it goes to PGBP head. If not, if these immovable properties were held as your assets, investments, and you are now selling it, it will go to capital gain head. So respective sections are there, but in either case, the treatment, the amount to be considered is same. So what does the law says? We give you two amounts. One is the amount which you are showing on your agreement. So let us call it as the sale price or the agreement price. And the other amount, which is the amount as per the state government stamp valuation. So let us call it as stamp value. Now, if your agreement price, sale price is higher, that will be the value to be considered while computing PGBP head income. In case stamp value is higher than your value, that is the value that you have shown, then the law requires that you do one calculation, that is add 10% to your value. In short, find 110% of your value. Now again compare it with stamp value. If this 110% is higher, then you consider your own value only. That is a value which you have shown as sale price or agreement price. Third possibility, even after adding 10%, the stamp value is still higher. In this case, stamp value will be the value to be taken for computing the incomes. Now, in this regard, there are two important points to be kept in mind. First point is, in case this stamp value is exorbitantly high and you do not agree to this stamp value, then you are having the option of referring this value to your assessing officer. You can request your officer to get this value rechecked. If this value is referred to valuation officer, you get the third value, which is the value as per the valuation officer. So let us call it as valuation officer's value. Now you were finding this stamp value very high, exorbitantly high, and as per the provision, the stamp value had to be considered for the purpose of computing income. So you referred your case to the assessing officer and he referred it to a valuation officer. Now, if valuation officer's value is less than the stamp value, his value will be taken as the final answer. However, if his value is even higher than stamp value, then you continue with stamp value. This is what is the provision. Fine. Now, the second very important point about this value or this point is that this value has to be considered as on which date. Now, there are different possibilities that one is the date on which you enter into this understanding, that is, you decide between yourself and the buyer that yes, this property will be sold, and the buyer agrees that yes, I'm going to buy this property. Now that is the first date. So let us call it as date of agreement. And then finally is the registration of the sale deed. Now many times there is a gap between these two dates, and between these gap, the stamp value has changed. So the stamp value here is, let us say, 120 and here is 150. Now between these two dates, that is the date on which you finalize this deal and the date on which all the registration formalities are done. Out of these two dates, which date stamp value has to be considered? The law says we will consider this date, provided you are able to prove it. How to prove it? The law says whatever advance or token you would have given as a confirmation of this deal, if that is given in cash or bearer check or even cross check, then we will not consider this, we will take this. But if this advance token is paid through account, pay, check or draft, through any online medium, through any banking channel, NEFT, RTGS, or any of the latest options of the QR as our very helpful to you, definitely. So students, this is all about 43CA and 50C. Now, the second side of provisions is the provisions of debit side, that is expenses side. Now for expenses side, what is the provision? The provision is that in order to claim expenses, that is in order to claim some amount as deduction in PGBP, there are two steps, two stages in which you will finalize this. What are those two stages? So the multiple provisions related to expenses, I have grouped them into two categories. The two categories are, first, you have some conditions. I've called them as golden rules. Those conditions have to be satisfied unless and until the expenses an exception, that is, that condition has been relaxed for that expense. Otherwise, that expense will be allowed as deduction only if it satisfies the condition. Second is, besides satisfying the conditions, still there are sections which are imposing some additional restrictions which have to be satisfied, or there are some provisions which are outrightly disallowing those expense, then anyways you cannot do anything. It will be outrightly disallowed. But until unless you cross both these stages, your expense cannot be finally claimed as deduction under PGBP. Now, these you have to apply by recalling the provisions or the conditions. This, before you apply the provisions, generally for applying these restriction provisions, you have to refer to the additional information which is given below every question. Because in that additional information, you will get the pointers for this restriction and disallowance provisions. Today, we are going to see this in detail. We had started this in the previous class by taking the small ones. Today, we are going to deal with all of them in detail. Now, first, we start with revision of the conditions, which I have called as golden rules. So whenever you are looking at the profit and loss on the debit side, for every expense, like you see purchases, you see wages, you see salaries, you see rent rates and taxes, you see printing stationery, you see repair maintenance, you see depreciation. For all these expenses, every item of expense where all the conditions are satisfied. Second is both. Since we compute income year on year, the expense should pertain to the respective year of which you are doing computation. So for us, it will be financial year 25-26. And last, the expenses should not be incurred in such a manner that there is any law which is forbidding that particular act, or there is any law which is treating your expense, your activity as an offense. So this is what is the important point. Now, with all this as the backdrop, you have to go to each item of expense in your profit and loss account and check whether or not you are satisfying the conditions, that is the golden rules. Now, few expenses are exception to these conditions, means for them these conditions do not apply, means you can claim reduction of those expenses without satisfying these conditions. So we'll recall all of them, we'll revise all of them. So first condition is expenses to be allowed as deduction should be a business expense, should be related to business. Now, exception to this are those expenses which are incurred for some aspect which is of national relevance. So these expenses, even though not related to business, have been allowed as deduction only because of their national eminence, national relevance. What are they? So expenses on family planning. So if there are any expenses incurred and the condition is the assessee should be a company only. So if a company is incurring any expense for promoting, for advocating family planning, its relevance, its measures amongst its employees, the company will get deduction. Only company will get deduction. If individual HUF is doing this expense, it will never get deduction. Now at our level of inter, we generally get questions of individual HUF. So this point has to be kept in mind that if the assessee is individual HUF in the question, you will not get the deduction. Second is where you are doing R&D. Now in our bare language, we call it as R&D, that is research and development. In the language of income tax PGBP head, They call it as scientific research. So scientific research expenses are nothing but expenses on research and development. Now, in this relation, there are two types of expenses. One, where the research is done by the entity or the assessee himself. Let us call it as in-house research. Second is where you are not doing that research. The research is done by some outside agency, which may be a scientific research association, college, university, organization, national laboratory, and these are research institutes like Bhabha Atomic Research Center, ISRO, all these are covered. Plus, even those private colleges, universities are covered, which are given the approval for carrying out certain researches. What is important to be noted is this condition is relaxed, which condition that the expense should be related to business only where the research is done by an outside approved agency. If you are doing the research yourself, which we call as in-house research, this condition is not relaxed. So, in-house research should be compulsorily related to business. So this condition that payment made to outsiders is only eligible as deduction if first this outside agency is approved and second, it may even not be related to your business. That is fine. The third condition is, or the third expense is donations. Now, where donations only word donation is used, you will always disallow it. You will never get deduction. Where donations are such that they are covered under the Income Tax Act, but under any series of Section 80, it will again not be allowed. So donations under Section 80 are not allowed. Why? Because they are allowed under some other provision, which is called as deductions under Chapter 6A. They are not allowed under the PGBP head. Only where the donation is falling under Section 35, then only you can claim deduction under the PGBP head. Now, two names you should recall, you should keep in mind because these are the most common ones. One, scientific research we have already seen. The other is agriculture extension, and the third is skill development. Law. Next condition is that the expense should not be a capital expense. If it is capital, again, you cannot claim deduction. Only revenue expenses are allowed as deduction. Exceptions are where the company is doing family planning related measures, and for that it has incurred revenue that is allowed full, no problem. Even capital is allowed by spreading it over 5 years so that you take 1/5 every year. Now, here, when you are doing in-house scientific research, and again, I repeat, this has to be related to your business. For this, if you are incurring any capital expenses, that is for carrying out research, you have set up a facility for which you have incurred expenses on construction, you have brought some equipments for doing R&D, all those are allowed as deduction. Third, capital expenses under Section 35 AD. This is a list of some specific businesses. These businesses which are covered in section 35 AD, if you are engaged in those businesses, you are eligible to take deduction of capital expenses, right? Students, remember one thing, wherever we are saying capital expenses are allowed as deduction, remember land is nowhere allowed as deduction. Even you are not eligible to claim depreciation on land. So there is no deduction for land even under this category of capital expense. Next requirement, your expenses are of current year. Now to this, the exceptions are first, only one future expense is allowed. Future means where you have created a provision. That is where it is for gratuity. Today we are going to study the conditions because only when you satisfy the conditions given under 40A7, even the provision for gratuity is allowed. Now, besides this one future expense, some past period expenses are allowed. That is the expenses already incurred in past, but you are claiming deduction in the current year. One is that family planning capital portion, that 1/5. So you would have purchased that capital asset 2 years back, but you are still claiming deduction now because of that 1/5. Similarly, before starting off business, the expenses that we incur are called as preliminary. In that, you are allowed preliminary expense for scientific research, plus the general preliminary expenses, what you consider even in accounts. Then, if you have formed by way of amalgamation demerger, the expenses that a company incurs, all types of legal expenses for doing amalgamation demerger, all these are allowed, and VRS is allowed. Now, importantly, all these are allowed again by spreading it over 5 years. However, when you talk about preliminary scientific research, it is allowed full. So this also you have to keep in mind which preliminary allowed in what manner. Then mining preliminary expenses are allowed by spreading them over 10 years. Now, this is not very common in the questions, but just for the purpose of knowing the provisions. These two are special experiments. In the flow over, there is a breach of contract where you're not able to fulfill the conditions which government may have put upon you for availing subsidies, or you are given some export performances which you cannot comply with. Now, all these penalties are fully allowed as deduction because what you have done is not an offense. So you have to be able to segregate, like smuggling is offense, trying to evade tax is an offense. So for this, if penalties are levied, they are disallowed. But breach of contract is not an offense. Not being able to satisfy the conditions imposed on you is not an offense. These will be allowed. So these are the golden rules, and these are the restriction conditions which today we are going to understand. There are only two major technical sections here which we are going to understand, we are going to decode, and I want everybody's presence, everybody's 100% involvement. So before I start with this, if you all have any questions, queries, you can put it over here. Balamurugan is asking, sir, what is section, subsection for agriculture extension? Yes, but it is same what you are saying. Still, let us reconfirm. So it is, if I am also recalling it correctly, it is 35 CCC something. Correct. That we can check with Balamurugan. Students, I give you 2 minutes. You can ask me your queries. Nagaraja is asking, sir, example of family planning. See, but I had explained that in the previous class also. So a company has to promote family planning amongst its employees. How it will do? One, it may print and paste some pamphlets, some handouts which may be given to employees, which give details about what are the ill effects of high population, especially in those families which are weaker when it comes to their economic resources. If they are having three, four, five children, how it will affect them. So when you have this type of, see, many times what is observed by the government is that when they started with this drive of controlling population, they identified that there is a lack of knowledge and awareness among people about high population. And also people were not aware of the various measures that are available to control population. So on either side, the government thought of giving them some education by promoting various companies to take up these promotional measures, these education measures. So the companies would be organizing some uh, training sessions, some lectures by some experts, and also giving them some handouts, some pamphlets, or on various specific places where, let us say, canteens where workers are regularly visiting, or even the parkings, they will put some handouts. See, this is done normally every in all scenarios. Like let us say when we are talking about cleanliness, we are talking about uh, environment. So how these things are promoted, you will find ads, you will find various handouts. So maybe one day may be celebrated as Environment Day. Similarly, one day may be celebrated as Family Planning Day. But for all this, the company has to incur expense. Let us say they will get a T-shirt printed out where something, some slogan is written, and that would be distributed, and the employees would be asked to wear the T-shirt and come in on a particular date in a month. So all these are various family planning expenses example. Ishwari is asking, 1/5 5 years is that means for all every 5 years we can get deduction. See, all means Ishwarya. So whatever is the expense, let us say you incur the expense in this year. Let us say preliminary expenses on scientific research. So you are carrying out some scientific research even before start of business, which is very much possible. R&D is done. You have a breakthrough. You invent some new concept product, and then you start business with that. So all these are done before starting of business. Now, whatever expense you have done on scientific research, that expense will be allowed by dividing it as by 5. So after the commencement of business for next 5 years, you will take that deduction 1/5, 1/5, 1/5, 1/5. No, Anil, family planning surgeries and all are not covered here because they are personal expenses. They are not covered. It is only for promoting family planning. That is giving the knowledge education. Yes, Nikhil. So what is your question when you're saying rent section 30, rent section 28? So what is your question, Nikhil, in this? Dhruti is asking, sir, if all these expenses are incurred for purpose of environment. No. See, right now family planning is given. Environment protection and all these things are not given. So for that, if you are incurring any expense, then that cannot be allowed as deduction. Why? Because, see, understand this. Simple logic. Don't get carried away by any technical language or any specific terms used. See, you are running a business. We have four conditions for allowing expense, Dhruti. Expense should be related to your business, revenue, current year, not an offense. And all are simple logical. Let us keep income tax and PGBP aside. Even when you are doing accounting, at least you will follow the first three. And we have followed. Why not fourth? Because in accounts, we have never thought of whether it is legal, illegal. So let us keep that aside. But first three you have also followed in accounts. So when you have followed all these things in accounts, so the same logics we are applying, that in accounts also you will not consider an expense which does not belong to that particular entity. Similarly, here we will only consider those expenses which are belonging to PGBP, that is business head. Now, expenses for environment protection, expenses for, let us say, water. Nowadays, even we are having this concept that in future there will be a shortage of water. So, protecting water resources, all these things are not allowed as deduction. Why? Is incurring those expense part of running your business? No. Yes, they may be national costs, they may be rather global costs, but that is if income tax law specifically covers them, that is a different thing. Otherwise, they are not allowed. Yes, Ishwari, I had already given example for capital family planning. I'll repeat. So let us say the company has to regularly conduct these programs, these sessions on creating awareness. So nowadays, every program requires a projector or that big screen on which they can run some ads. Ad means some small clips, some videos, some promotional content. So for that, the company has purchased a projector or that big LCD screen where the workers can come to that conference room in batches, and that screen or that projector is used to play some lectures or some promotional whatever content the company has developed. That is how you have capital expenses. Ishwarya, please, what you are saying, capital revenue, I did not get. So your question is on expense or revenue? Because here we are talking about expenses for family planning, capital and revenue. So revenue expense is simple, na beta? All the see what is capital and revenue, that is coming from accounts. So revenue expenses are the regular repetitive expenses. So as I gave you example, expenses on getting t-shirts printed to be given to employees, on pamphlets. If you are asking some knowledgeable person, some expert to come and give guidance, that expert's remuneration, all these are revenue. Correct? Sure. Just give me 1 minute. Okay, perfect. So students, we are all set. Now, when we are talking about these restriction sections or these sections creating disallowance, I today mentioned at the start that how these restriction sections will apply in a given exam question. So today we are going to study what are those restriction conditions. In exam question, you will be applying these restrictions majorly on the basis of additional data given. Yes, for few of them, by reading the name itself, you will get to know the restrictions. But for others, since the restrictions are applicable to all expense, you will apply the restrictions only by reading or knowing the adjustments. I'll give you an example first. If you recall, in the previous class, we had done something like this practical question we had done. Now, if you see in this practical question which we had done, here I had given you an adjustment that administrative expenses include something which is disallowed under 40 clause A. Now, since this was a very basic sum, I wanted to give you an overview or an understanding of how PGBP sums are and how they are solved. I did not give the condition here. Now, when we are going to solve actual PGBP sum, this will not be given in the question. What it will say that administrative expense include 10,500 for which, and then they will give you some content that this has happened. Now, reading that content, you have to now apply one of these restrictive provisions to identify that whether you have satisfied the restriction condition there. If the restriction condition there is satisfied, you say that, okay, I have satisfied the restriction condition, the deduction is allowed. But if the restriction condition is not satisfied, then you will say, okay, the deduction is not allowed. because restriction of 40 clause A is not satisfied. Similarly, here also you see, you'll find references of sections. Now, since these are the starting questions just for the purpose of giving you an overview of how PGBP format works, how the sums are solved, here I have directly given you that some expense is disallowed under this section, some is disallowed under this section, but that is not how it will be. When you are actually solving the sum, you will be given some data over here. And applying the respective section content to this data, to this information, you will decide whether or not finally the expense has to be allowed under the respective restriction section or it has to be disallowed. Correct? So just keep this in mind. Virali will do that. I purposefully did not solve it that day. We'll solve this also as a practice. But I first thought we'll understand the provisions. So I'll give you the answer. Don't worry. We'll solve it. In fact, y'all only will solve it. Now, be very attentive. Next 45 minutes are very interesting. You may find it slightly technical, no problem. We will be revising these sections again and again in all our future classes. But you have to be very pinpointed because today we'll be covering the main part in PGBP, and after this, you are 75 to 80% ready for the actual PGBP sums. Okay. Now we are reading those sections which are creating some special or specific restrictions, or they are outrightly disallowing certain expenses. Now, in 40 small a, so we call it as 40 clause A because it is small a, so it will be called as clause. When you read the Bare Act, there are multiple subclauses by the number 1, 1A, 2, 3, and so on. But when you read all these clauses, broadly, all these clauses talk about only two things. So what I've done, instead of going clause wise, which you can read from your module also later today, I have tried to club and make it into two broad categories, which these clauses are covering. So what does 40 clause A covers? It covers broadly two types of restrictions. One, if your expense is a direct tax. Now, commonly you will find this in any P&L. On the debit side, there would be some taxes which are debited. Now be clear, if those are indirect taxes, like even in this previous sum which we solved, if you see here, there was customs duty, which is an indirect tax. Here there was GST, which is an indirect tax. What we did, if you remember, we allowed the deduction because the restriction which we are reading is not for indirect tax. The restriction is for this. Now here, since it was first sum, I did not name it income tax. Earlier, there was also wealth tax. So we know that there are two types of taxes, direct and indirect. If it is an indirect tax, there is no problem. Why? Because indirect taxes are business taxes. So there is no restriction on the allowability of indirect taxes. The restriction is on direct tax. So what is direct tax? Your income tax. Interestingly, employer at times also pays the income tax on the income of employee. So payment of income tax by the employer on the income of employee. So this is again an example of direct tax. And then there are some fees, levies, royalties of state governments, which are to be treated as tax. This is as per law. Fine. What is important is just keep one thing in mind. If your P&L shows an expense in the form of income tax, advance tax, or provision for income tax, all these are outrightly disallowed. So what does 40 clause A says? 40 clause A says any form of direct tax will be disallowed. Am I clear? Perfect. Now, that was simple. What is important is second category. This is one of the most interesting provisions in the entire income tax law. Not only PGBP, definitely it will be the most interesting provision of PGBP also. But in the entire income tax law, if there are 10 very special sections, this is one of them. Now, this section covers majority of these sub-clauses. So when you read the law, when you read the module, and you go to 40 clauses, you'll find multiple sub-clauses, but all are talking about the same thing. So I have category. Now, what is this? You will be studying a chapter on TDS and TCS. I'm sure you all know what it is. At least full forms you all know. It is tax deducted at source. Now, what it is, let us understand. I'm a businessman. When I'm running my business, I have to pay many expenses, starting from salary and wages, rent, then some contract charges, expenses where I've given some contract. So there are multiple expenses which I'm paying. Now, what is TDS? Let us first understand TDS and then we'll come back to this restriction. When I'm paying these expenses, let us say you are all those agencies, you're all those persons to whom I'm paying one of these charges. Now, in my hands, these are expenses. But in your hands, like let us say you all are my employees. So whatever salary wages I'm paying to you all, in your hands, it is your income. Let us say one of you is the owner of that factory premises where I'm running my factory and I've taken that premises on rent. So when I'm giving you rent, which is my expense, it is your income. Somebody has done some work for me for whom I have given them contract, labor contract, transport contract, whatever. So contract charges, and then there are so many expenses. Now, what is the TDS concept? TDS concept says that one man's expense is another man's income. Now, when I'm making payment of this expense, tomorrow you have to go and pay tax of the same amount, which is your income. But what if you do not honestly show this and pay the tax to the government? So the law has been so designed, it says that when I am making payment of expense, let us say the expense is rupees 1 lakh. They said don't pay the entire 1 lakh to the recipient, that is to you. There is some rate of tax given in the TDS chapter. So TDS chapter gives you against the names of various expense, the rates of taxes. So let us say the rate of tax for this payment given is 10%. So we call it as the TDS rate because it is not your final income tax rate. It is just a rate given to deduct the tax. So when I'm making the payment of my expense to you, and let us say the TDS chapter has given the rate as 10%, the law says, the overall income tax act says, I will pay you 90,000. So physically what I'm giving to you in hand is 90,000. And this 10,000 which I have deducted as TDS, I'm directly depositing it with the government in your name on your behalf. So this TDS chapter requires me to first deduct this TDS, which in this example I'm assuming as 10%, so it is coming as 10,000. And after I've deducted this from your payment, on a specified due date, I will go and deposit it with the government. So the intention of TDS chapter is, I'm not yet talking about this 40 clause restriction, I'm still talking about TDS concept, that whenever I'm making payment, anyways, see, I have to make payment of entire 1 lakh. Now, how I'm making it in two parts. Net amount I'm giving to you and the TDS portion, the tax portion I'm handing over to government. So for me, the payment is still 1 lakh. So I'm least bothered how this 1 lakh is going out. I have to anyways pay 1 lakh. But the law require me to pay it in two parts. So your income was 1 lakh. My payment is 1 lakh, but it will be split in two parts. I will first deduct the tax portion, which is called as TDS. That is why it is called as tax deducted. I will deposit it with government in your name. So in your name only, I'm depositing it with government. So it is like your tax is getting paid to the government. And the net amount is given to you. You are the pay. I am the payer. Correct? Now, the purpose of this entire TDS concept is that government should receive this tax so that tomorrow in future, if you are not disclosing this income for some reason, you are trying to evade tax, still the government has got some tax on it. That was the ideology of bringing in TDS chapter. Fine. Done. Now, this entire TDS will be done by whom? By the person who is incurring that expense and who is making the payment of all these various expenses. Now, this person generally is running a business. So for him, these expenses are his PGBP or business expenses. PGBP head has brought in this restriction, this condition that if I, that is the businessman who is making these payments, if I fail to comply with TDS, now PGBP chapter says that I am making payment of these expenses to you all, and I am going to claim these expenses in my PGBP head as a deduction. These are satisfying all the above four conditions: revenue nature, current year, not a offense, and also these are my business expenses. But this restriction says I will not be able to get the deduction if I have either not deducted or after deduction if I have not deposited with government. So this restriction, what we are right now discussing, has a linkage with the TDS chapter. And in the TDS chapter, wherever you were required to deduct the TDS, this PGBP section says, if I fail to deduct the TDS or I have deducted the TDS, so I have paid you net 90,000 only, but I have failed to deposit this money with government. So I should do both. Not only deduct, I should also deposit this amount with government. So if I fail to deposit, then I will not be allowed deduction. So now I'm reading it. What is it saying? This is in simplified language, which is not the legal language, but for your understanding, I have curated this provision into simplified language, where any expense, I'm adding this word, where you are claiming any expense, which expense, but on which TDS is applicable. Now, 90% of your P&L expenses are covered in TDS chapter, but still this point is important because if on any expense TDS is not applicable, then why will you deduct TDS? So obviously we are talking about those expenses on which TDS is applicable. Now, what does this 40 clause A restriction says? If there is an expense on which TDS was applicable and you forgot to deduct the TDS, one thing, or you deducted, but you did not deposit the TDS with government. So you should do both. First, from the payment, you should deduct the TDS. Now, many times people don't know that there is TDS, or they don't know that on this payment there is a TDS. So first condition, check whether they have deducted the TDS. If they forgot to deduct TDS, then also the expense will be disallowed in PGBP head. Or They deducted the TDS. They knew that there is TDS, so they deducted it while making payment. But for some reason, they have not deposited the money with government. Now, for any of these defaults, non-deduction or non-deposit, they say, we will not allow you deduction. We will not give you deduction of this expense while computing PGBP income. So, in a way, you can say PGBP had 40 clause a restriction is indirectly trying to make you comply with the TDS. So as a businessman, as a payer of expense, you were supposed to deduct and deposit that money with government. If you fail to do it, you are penalized. How? In your calculation of income, even though this is a valid business expense, satisfying all the four above golden rules and conditions, but you cannot deduct it, you cannot claim it as deduction. Let us first understand this concept principally. Ishwar is saying even provision is not allowed. See, even when you are creating provision, when you will study TDS chapter, you will get to know that even on provision, you should have deducted TDS. So it is not that only while making payment. The law says when you read TDS chapter, for majority of the expenses which are covered over there, they are saying you should deduct TDS when either on actual payment or when you are simply creating a provision in books, whichever is earlier. So by default, even provisions will be covered. So whenever you are creating a provision, deduct TDS. Now, what is the importance of deducting? So the moment you say I have deducted TDS, immediately next month you have to go and deposit the TDS. So you'll have to also comply with the payment. Neeraj is saying, sir, but if they have not deducted TDS on expense, then it means the TDS expense is not shown in P&L. Why not shown, beta? See, P&L, understand one thing, Neeraj. P&L is drafted on the principles of accounting. In accounts, if anything is an expense, you will show it in P&L at the end of the year. Correct? And second thing, whether you show anything in P&L or not, it has nothing to do with income tax. In income tax, even if P&L shows a particular expense, we may still not allow it. Vice versa, even if an expense is not shown in P&L, but income tax says we allow deduction, you'll allow it. Example, I'll give you capital expense. You generally do not show capital expense in P&L, but still where in those three scenarios, wherever we studied that capital expenses are allowed, I will give you deduction in PGBP. So don't say that if something is not shown in P&L, how there will be deduction in income tax. We are not dependent on P&L to give you the deduction. Correct? We give deduction on the basis of income tax PGBP head provisions. Nagaraja beta, please type completely, because if you're writing only one or two words, I'm not understanding what you mean. You are saying TDS is liability, then you are saying provision. I did not understand what is your query. If it is only that you are informing something, fine. If you're asking something, please be detailed. Or if you want, I will unmute you. You can ask me by explaining your query, because by this much, I'm not able to understand what exactly you mean to say. Okay. Let us proceed. Now, what is 40 clauses saying? So you are making payment of some expense. Let us say I'm taking example of rent. Anil, pay attention, you'll understand. How much rent I have to pay this month? Let us say I have to pay 50,000 rent this month. So month on month you are paying, correct? And TDS is 10%. So practically what I should do, I should give to the property owner 45,000. That is the check or whatever the manner I am paying. I should transfer 45,000 to that person's account. 5,000 I will keep it aside by the name TDS. This I will do for all the expenses of this month, salary, rent, wherever TDS is applicable. And then On the specified due date, I will go and deposit this money in the government's bank account. And then again, on the specified date, I will file a TDS return in which I'll give details of all these payments with your names, that which payment belongs to whom, and the amount of TDS which I have collected and I'm depositing. So this will be given in the TDS return, which is filed quarterly. So month on month, for different expenses, wherever TDS is applicable, I'll deduct that much tax. I will pay the net amount, and the tax I will be depositing in the government bank account, and I will be filing a return. Return is the detail showing, because see, I will be depositing one lump sum amount in the government account, right? This lump sum amount, let us say, is 2.5 lakhs, 3 lakhs, 2.2 lakhs. Now it covers whose TDS? That is given by way of this TDS return. Perfect. Yes, Nagaraj, you're right. Shlesha says TDS is applicable on expenses. Expenses are debited to P&L. We reduce TDS amount from expenses and then expenses paid and TDS deposited with government. Perfect. Perfect. Yes, correct. You're right, Ashlesha. Perfect. So this is how accounting entry will be done. You're right. Now, all this was about TDS. Now let us come to PGBP. Now just pay attention, students, so that you'll understand this. I have to do PGBP computation for the whole year because you are preparing trading P&L at the end of the year. And similarly, at the end of the year, we are doing our income tax computation. Now, why I'm emphasizing on this, so that the condition which I'm going to explain now will be clear. Now, at the end of the year, in my P&L, I find all these expenses debited, and obviously these expenses are now the annual expenses. So salary, wages, annual, rent rates, annual, um, contract charges, annual. So this covers amount of the whole year. And during the year, every month you are doing or not doing the TDS. Now, what I am supposed to check as a tax consultant while doing your PGBP computation is that did you first deduct the TDS, and second, did you deposit that TDS? Now, what this section 40 clause A and various subclauses 1, 1A, 3, etc. says that you should have deducted the TDS during the previous year. Now, we all are doing computation for the previous year, 25, 26. This is your previous year, correct? Which is ongoing right now. Now, I am going to check that whether or not you have deducted the TDS of all these expenses. And what I want to check over here, or what I am supposed to check over here, is these should be deducted any time during the previous year. So in this case, by 31st of March 2026, which is the last day of the previous year. Obviously, since these expenses are belonging to the previous year, so obviously the condition is that you should have deducted the TDS anytime during the previous year. So what I will be checking is for all these expenses, whether or not you have deducted the TDS during the previous year. If the answer is no, then I will directly come to this point, because what I have written in this point, if point 1 is not complied, what is the condition in point 1? You should have deducted the tax during the previous year. So I'm giving you the date, because in your exam questions, checking these conditions with the respective dates is very important. So the date is very important when TDS is deducted. TDS can be deducted any time between 1st April 25 to 31st March 26, which is your previous year. In short, you have to keep the last date in mind, that whether or not the TDS is deducted up to 31st March 26. If your answer is no, they have not deducted the TDS during the previous year, that is up to the end of the previous year, which is 31st March 26. So the condition is not complied. If the condition is not complied, I will disallow that expense. Now here, what is important is how much of the expense is disallowed. Now here, in those different subclauses, when you will read in the Act, you'll find that broadly the payments can be divided into two categories. One, payment which is made to a resident. Now you all know who is a resident in India. And the payment is also made in India. So two conditions, the person should be resident and the payment should be made in India. Second possibility, the payment is made to a non-resident or it is made to a person who may be resident or non-resident, but the payment is made outside India. So two conditions. It is made to a non-resident or to any person, but the payment is made outside India. Now, what is the difference? The difference is if my expense is of the second category. What is the second category? The person to whom the payment is made is a non-resident, or who he is any person, resident, non-resident, but the payment is made outside India, then entire expense is disallowed. So let us say your expenses has a payment called as technical fees. This technical fees is rupees 5 lakhs, which is debited in your P&L. Now, first, you check all the four conditions. Is it related to business? Yes. Current year revenue, not an offense. Everything is satisfied. But in the additional information, they have said that this technical fees is paid to a German technician who has provided some technical know-how, some technical assistance in your business, in your production. Now, the person is a non-resident. Maybe payment made anywhere, but anyways, any one condition has to be satisfied. Either the person is non-resident or the payment is outside India. Here, maybe both are satisfied, but point is the person is a non-resident. Now, if it is given in the additional information that while making this payment, you did not deduct TDS. So like maybe you forgot or you are not aware that even for non-resident TDS should have been deducted. It means you made the entire payment full to that person. So what has happened? My condition is TDS should have been deducted anytime during the previous year. It is not deducted. It means I have not complied with 40 clause A. And my payment is of second type. What will be the effect of this? I will not get this deduction. So your conclusion will be that deduction of 5 lakhs is not allowed. So what you will do, like here, now again, I come back to the practical question. I had mentioned directly that this much amount is disallowed, or here I have said that this much amount is disallowed under this section. Now, as I said at the start, you will not be given so straightforward that this much amount is disallowed under this section or something. You will be given the adjustment like this. So for example, the adjustment would be given that technical fees is paid to a German technician without deducting TDS. So additional information will be like this. Now, when you read this additional information, let us say this technical fees is debited here. So two technical fees, 5 lakhs. Now, when you were checking this expense, what you check first? Four conditions. Is it related to business? Yes, because the technician was hired for my business. Is it current year? Yes. Is it revenue nature? Yes. Is this payment an offense? No. So all four conditions are satisfied. So I've crossed my first barrier of allowing expense, that is satisfying all four conditions. I have satisfied. But the second barrier of restriction and disallowance get attracted because of this additional information. What is the additional information given? That this technical fees is paid to a German technician. Means I know that he is a non-resident. And it is further said without deducting TDS. Now, the moment I read this, in my head, I will recall 40 clause A. Don't get into that sub clauses, whether it is 1A, 2, 3, that makes no difference. Even if you say 40 clause A, that will be sufficient for the time being. Now, what is my conclusion after reading this additional information? That I have not satisfied the restriction put in 40 clause. And I have not deducted TDS. And since the payment is made to non-resident, entire 5 lakhs, which is the 100% expense, is not allowed as deduction because of this restriction of 40 clause A. Ashlesha is asking, sir, what if you would have paid this expense in India? Still the same rule. Why? See, Ashlesha, that is why you should read things, rather everyone should read, especially when you're reading law, read it very minutely. What I have written here. Pay attention. Payment is to non-resident or any person outside. So when I'm saying payment to non-resident, then this outside India is not necessary because the word is or. So payment made to resident in India or outside India, answer remains same. And payment to any person. Now here, whether it is a resident or non-resident, but the payment is outside India. So for both these, rule is how much expense will be disallowed? 100% will be disallowed. Yes, but Ashlesha, correct. So what will be my answer, students? See, I'm taking example of a practical question so that you'll understand it better. So it will be disallowed. Correct? I hope this is clear to everyone. Now I come back to this adjustment. Now this was given very simply because it was your very first sum of your life. Let us say nothing of this is given. Instead, what is given over here? Administrative expenses are contract charges to an Indian contractor on which TDS is not deducted. Now I have made the actual condition that you will get in the exam problem. That how it will come? Administrative expenses are what? They are contract charges to an Indian contractor on which TDS is not deducted. Now I'm talking about this. Now on this, TDS is not deducted. The moment you read TDS, you should recall 40 clause A. Now what is 40 clause A saying? 40 clause A is saying that wherever TDS is applicable, TDS should be deducted anytime during the previous year, but I have not deducted. Or chalo, I'll modify this just to give you the flavor. Let us say the question says, administrative expenses are contract charges to Indian contractor on which TDS is deducted on 10th April 2026. So instead of saying not deducted, I've changed this just to give you the flavor. It is saying TDS is deducted, but the date given is 10th of April 2026. Now, what is our condition, students? The condition is TDS should be deducted. What is the condition? It should be deducted during the previous year itself. And that is why I said last date for use 31st March 26. Now, if in the question it is given that it is deducted on 10th April 26, it means it is deducted after the end of the previous year, again 40 clause A is attracted. See, whenever it comes to TDS, you will go to 40 clause A because for TDS, the restriction is 40 clause A. Now, since you have not deducted the TDS during the current year, you are not satisfying one of my conditions of 40 clause A. And the moment you do this, we attract the disallowance. Now, what is the disallowance? I am making payment to a resident and the payment is made in India. Now, see, they have not given anything about where the payment is made. So these are certain assumptions. If it is to a non-resident, nothing is given where it is made. You always assume it is paid outside India. If it is to a resident and nothing is said where it is paid, you will always assume it is paid in India. So the payment is to a resident. So since the payment is made in India, the payment is made to a resident, even if where is not given, you will assume it is in India. Now what will happen? Now, since I have made payment to a resident, but I have not deducted TDS during the previous year, I have done it, but after the end of the previous year, again 40 clause A disallowance applies. And now, since the payment is to a resident in India, the disallowance is 30% of the expense. So what will happen? Now, this expense was otherwise fully allowed. Why? Because all the four conditions are satisfied. Is a business expense? Yes, because the contract work is related to business. Is it current year? Yes. Is it revenue nature? Yes. Is it an offense? No. So all four conditions are satisfied. So otherwise this expense is allowable. But because of this 40 clause A restriction, out of this 30%, which comes to 10,500, will be disallowed. So out of 35, 30%, which comes to 10,500, your answer is it is disallowed because of 40 clause A restriction not being satisfied. Students, I hope you all are understanding this. Please confirm. So there are two things. One, payment to a resident or payment to a non-resident. Perfect. Great. Yes, Ashlesha. So in your reconciliation, whatever we now decide that this is disallowed, since this amount is already debited in P&L, what will be your treatment in the final format of reconciliation that we studied at the start? You will add it over there. You're right. But right now, I'm not taking you to the add list because right now my focus is on the PGBP provision part to understand whether it is allowed or disallowed. If your answer is coming, it is disallowed, then you go to the reconciliation. What was our rule in reconciliation? Anything which is debited to P&L, but it is disallowed in PGBP, you will add. So in this example, I will add 5 lakhs full because non-resident 100% is disallowed. And for this contract charges, I will add 10,500. So two answers. That is two treatments. 5 lakhs payment to non-resident disallowed full. So 5 lakhs entire added. And for this payment to resident, out of 35,000, only 30% is disallowed. So only 10,500 I'm going to show as add in my reconciliation format. Let's see. Disha, you're very correct, but let us go step by step. See, I cannot jump to the last point right now because right now things are getting percolated. As I said, now this is one of the most technical provisions of entire Income Tax Act, not only PGBP. So I'll have to take it with a very slow pace so that it gets absorbed. And I have mentioned at the start of this chapter of PGBP that this is the most important chapter in your entire career as a tax professional. So if you are practicing in direct tax, the most important topic of your career is PGBP. And in that, this is one of the most tricky adjustments. Many times students do not understand. So let me not be very uh, enthusiastic and ambitious. I'll go slow. What you are saying is perfectly right, but I'll not talk about this right now. I'll talk it at the end. Yes, Anil, you're right. You're perfectly right, buddy. Okay, so moving forward. Now the second point. What I'm supposed to do? I'm supposed to deduct the TDS during the previous year. Now I change my example. I have deducted the TDS. When? Within 31st March. So I'm changing this example again. I have deducted the TDS here on last date. So I'm satisfying the first part of the condition that the TDS should be deducted anytime during the previous year. I have done this. But this is not sufficient. I should have also deposited the TDS. Now, interestingly, what does the PGBP says? Now, here students pay attention. There is one due date which you are going to study in the TDS chapter, which is given for depositing the TDS of every month. And the last month of March, they have given you due date by which the TDS should be deposited. So there is a due date, but which due date? TDS due date. Here, PGBP head says, first, you should have deducted any time during the previous year. And after deduction, you should have paid, you should have deposited this within due date, but not this. They are not talking about the TDS due date. So you have to comply with TDS due date. That is the part of TDS chapter. Here for PGBP, they want you to deposit it anytime up to your due date of return filing. So understand the students, what PGBP chapter requires here in 40 clause A is that you should have deposited this amount anytime during the, I'm just slipping out so that it is easy for you to understand. So you should have deposited it by when? I am not concerned here about the TDS due date. In this chapter of PGBP, we are not looking at any due date of TDS. Like deduction during the previous year, TDS chapter has a different date for deduction. We are not looking at that. For PGBP, we want deducted up to the during the previous year. So I gave you this date, March 26, 31st March 2026. Similarly, the payment that is deposit with the government should also be done not up to this due date of TDS. So for the time being, don't look at the TDS chapter due date. You should have deposited it anytime up to your due date of return filing. Now, here, students, there are three different due dates of return filing. What are these due dates? If you are engaged in some specified international transactions, you should have filed your income tax return by 30th November of the next financial year. So after 25-26 ends, you should have deposited it by 30th of November 2026. If you are engaged in specified international transactions. If you are not engaged in specified international transactions, then one of these two due dates will apply. First, if you are a company or if you are a person to whom income tax audit is applicable. Now you'll study this income tax audit in this chapter at the end. So if income tax audit is applicable to you, or if you are a partner in such a partnership firm to whom income tax audit is applicable. So either you are the partnership firm or any entity to whom the income tax audit is applicable, or you are a partner in that firm into which income tax audit is applicable, then for you the return filing due date is 31st of October 2026. And then finally, for other assessees, that is other than these, the due date for filing income tax return is this. Now, what is the condition here? that the TDS which you have deducted during the previous year should have been paid to the government, should have been deposited with the government up to latest your due date of filing income tax returns. Now I come back to the question. Let us say for this person, income tax return due date under section 139(1) is 31st of July. Now for whom, what is the due date, that we will see later. Right now, this is given in the question that for this person, the due date is 31st July. So he should have filed his return by 31st July 2026. Now, I complete this adjustment. Administrative expenses are contract charges paid to Indian contractor on which TDS is deducted on 31st March. And now here, either they are saying not deposited at all, or they are saying deposited on 15th of August 26. So what is the adjustment given? Administrative charges are what? Contract expenses paid to Indian contractor, either on which TDS is deducted on 31st March, but either it is not deposited at all, or it is deposited, but by when? By 15th of August 26. Now, in both cases, if it is not deposited at all, or if it is deposited on 15th August 26, again, you are breaching 40 clause A condition. The 40 clause A condition was one, deducted during previous year, which you have done, and deposited before your return filing date, due date. Now, either you have not deposited at all, so still you have breached, or you have deposited, but after your return filing due date. So you have breached 40 clause A. And if you breach 40 clause A, what will happen? Same consequence. If the payment is to a resident person and the payment is made in India, 30% of expense will be disallowed. If the payment is to a non-resident, to any person or to any person outside India, 100% of expense is disallowed. So here the answer will be that 10,500 will be disallowed. Perfect. So you are getting it perfectly now. See, Dhanalakshmi, if the payment is for a resident person, but the payment is made outside India, 100% disallowance applies. So please be clear. Either the payment is to a non-resident, 100% disallowance. Payment is to a resident, but paid outside India, still 100% disallowance. So when 30%, payment is to a resident and the payment is made in India. So both conditions. So there is and to a resident and in India, then 30%. If it is to a resident but outside India, 100%. Correct, Dhanlakshmi? So students, this is what is the disallowance under 40 clause A. So either TDS not deducted up to the end of the previous year, or after deduction not deposited up to your return filing due date. This is very important. Not up to the TDS due date, but to up to your return filing due date. I hope this is understood by all. The disallowance under 40 clause A. Yes, Lingar beta. So if the payment is made to a resident and the payment is made in India, both conditions. So it is and payment is to a resident person who is a resident of India and the payment is made in India, then 30% is disallowed. Is this fine, students? Great. So this, according to me, was the most interesting condition, because there are two conditions, different dates, different percentages, but I'm sure it is not clear. So Ishwarya, wait now, you'll get answer after the break. I don't want to mix too many things together. Correct, Ishwarya? Good. So students will go in for a break, and after break, There is something else in this, but I do not want to merge too many things so that things are going smooth. Now we have completed the restriction. Now there is some relaxation. So see, if you observe my notes, there are certain things which are marked in red, certain things which are marked in green. So there is a relevance of this red and green. So red is where something is restricted to you. You are not given deduction. It is restricted. You are not allowed deduction. It is in red. So wherever I have marked in red or the something is written in red, it means it is against you. You are not getting the deduction. If something is green, it is in favor of you, you are getting the deduction. So don't worry, we'll come back to this. Let us have our 15 minutes break. So refresh yourself, have something for your stomach also. We come back. continue. So, there are something. So suppose TDS deducted 10,000 on 31st March and paid 31st July. What is the accounting on interest earned on 10,000 for 4 months? Means time gap of deduction date and payment date. See, Deepak, you have a very good question. So if there is a time gap between deduction date, payment date, so this all you study in the TDS chapter. In fact, in the TDS chapter, the due date for deduction and payment is different. So over there, the interest may start much earlier. This date that you should deduct it maximum by 31st of March, that is end of the previous year, and deposited by return filing is the due date of income tax law for PGBP chapter. But there is similarly a due date in the same income tax law in the TDS chapter where the TDS has to be deducted and deposited by a specified date, failing which the TDS chapter starts imposing interest, which is on per month basis. Why I'm not getting into that interest point here? Because I do not want to unnecessarily overload you with that information which may not be relevant for this topic. But yes, you're right. There will definitely be interest for late payment. But that would be as per the TDS chapter due dates. So what we have understood, students, till now in this section 40 clause A, TDS restriction, that two things have to be checked. Now this, again I repeat, will be checked only on the basis of the additional information given. So this you cannot check or cannot presume anything. So if in the question, in the P&L, there are multiple expenses, many of them are liable to TDS, but if nothing is given in the additional information on TDS, you presume that for all the expenses, the TDS compliance has been done as required. Only when there is some additional information giving some additional data about when TDS is deducted, when it is deposited, that is only where 40 clause A has to be checked. If nothing is given in additional information, yes, you know that all these expenses are liable to TDS. This you'll get to know once you study TDS chapter. But you cannot presume that TDS is not done. So in simple words, this restriction has to be applied basis the additional information given about TDS. So what we have understood till now, that wherever TDS is applicable to you, you should have deducted it anytime till the end of previous year and deposited it anytime till your due date of filing returns. Failing which, if you do not do any one of them, the expense may be disallowed. How much? If the payment is made to a resident and the payment is made in India, both conditions to be satisfied, 30% of the expense is disallowed. If the payment is made to a non-resident or to a resident but outside India, 100% of the expense will be disallowed. Correct? So this is what we understood till now. And this is a very strict provision. However, this provision has made some relaxation. Now the relaxation is that, let us say you have not deducted the TDS. So you should have deducted the TDS, but you forgot to deduct the TDS. However, your payee, so in my case, I'm the payer, you are my payee. I forgot to deduct your TDS, so I made the payment to you, but you have honestly disclosed that income in your income tax and computed tax on it and paid the tax on it. And you have given me the proof. In that case, the purpose of TDS is satisfied. So even though I did not deduct TDS, but you have considered that income in your computation, paid the tax on it, and you have given me the proof, then I am still eligible for deduction. So what is the first relaxation? First relaxation is about the first condition that I should have deducted the TDS, failing which expense will be disallowed. To this, the relaxation is even if I fail to deduct the TDS, but if you, that is the pay who has earned this income, has honestly disclosed the income and paid tax on it, and has given me the proof that you have paid this tax, I will get the deduction. Correct? There is some technical point here, but I'm purposefully not doing it. I want to give you in small pieces. This we will come back when in the next class we will revise this whole thing. I will add this additional point. So for the time being, I'm not getting into that technical detail. Second relaxation is, let us say I deduct the TDS, but I fail to deposit the TDS. Now, you know, both different independence conditions were there. First is deducting TDS and second is depositing TDS. Now, what is the second default? I deducted the TDS but failed to deposit it. Now, this was the question asked to me already by two people, but I had asked them that I will explain this later. So now that is the point. Now, what is this point? Let us say I failed to deposit the TDS. By when? Up to the due date of filing returns. So what we studied above, the expense will be disallowed? Yes. But what if I go and deposit this anytime in the future? So now giving you example, let us say the expense is of financial year 23-24. It is rent rupees 10 lakhs. TDS deducted then, but failed to deposit. So, sorry, I should write it here. So there is an additional information here. Rent of financial year 23-24, rupees 10 lakhs, on which TDS was deposited on 5th November 25. So what is this information now saying? Now there is some expense of some earlier period on which TDS was deducted then. Now this is the presumption from the language because they are only talking about deposit now. It means it was deducted then. But they did not deposit it then. They deposited in the current financial year, which is 25-26. Now understand the implications of this. See, many things will not be given black and white. You have to understand. So if TDS was not deposited then, why? Because it is deposited today. It means in that year, there would have been disallowance under this 40 clause A. Yes. How much would have been disallowance? The disallowance would have been 30%. That is 3 lakhs would have been disallowed. Correct? In that year. Now, if that year's TDS you are depositing in the current year. Now, what does the law says? No problem. This amount which I had disallowed you then. Why? For simple reason, you did not pay my TDS. So if you're paying the TDS today, now take this deduction of rupees 3 lakhs in the current financial year's returns. So what does same 40 clause A says? In one part of the 40 clause A, it is disallowing. In the second part of 40 clause A, it is allowing. What it is allowing? Expense of past periods, which were disallowed in those years, in that period. Why? Because you did not deposit the TDS in that year's period, which was allowed to you of filing return due date. You did not deposit, but you deposited it in the current year. So what does the same 40 clause says? We will allow you deduction in the current year. Now understand this, out of 10 lakhs, 30% was disallowed. So 30% will be allowed. Now, all this is not given in the question. The question only says rent of financial year 23-24 rupees 10 lakhs, of which TDS was reported on 5th November. Only this much is given. You have to interpret the other things. What? In that year, 30% would have been disallowed, means 3 lakhs is disallowed. And as per 40 clause A, what was disallowed then will now be allowed because in this year you have complied with my provision. So this you have to interpret yourself. Correct? Thank you, Neeraj. So Nagaraja is saying this allowed portion is added back to income under PGBP. Nagaraja, you are being slightly hasty. Haste may not be helpful. So you may have interpreted the provision correctly. So you interpreted two things. One, in that year, 30% was disallowed. And two, that 30% will now be allowed. So till now, you are perfect. But then this haste may cost you everything. You are saying this disallowed portion is added back to income under PGBP in this year. No. But first, students, what is the relaxation? The relaxation says if assessee had failed to deposit the TDS in some earlier period, but he deposits the same now. So subsequent year is now, he shall be allowed that past year expense in the current year, that is the year in which he has deposited TDS. So 23-24's expense will be allowed in 25-26. Obviously not full. Out of 10 lakhs, you have claimed 7 lakhs, then only 3 lakhs was disallowed. So whatever was disallowed will be allowed now. Correct? Students, let me know your questions. Kuldeep, which page are you referring? I did not get beta. Dhruvika, beta, yes. I will request the technical person to share the WhatsApp group link. So you'll get the link beta here. Kuldeep, beta, you are referring to this page. Okay, so this is page 6. Okay, fine. But where he, which he you are talking about? Here he is me, the payer. If you're talking about this he, it is me. You're talking about this he, it is me, the payer. See, I had to deposit the TDS because I have deducted your TDS. That money is with me. So now I will go and deposit it on your behalf with the government. Correct? So he is me, the payer, because the payer had deducted, payer did not deposit. It was disallowed to me, that is the payer, and now it will be allowed to me, that is the payer. Everything is of payer. Now, students, if you have understood this, I'll come back to something interesting. You remember this golden rule. What was the golden rule? We will only allow you deduction of expenses which belong to the current period. But in that, we have exception where some cases past year expenses are also allowed in the current year. What is that? Expenses pertaining to some past period which was disallowed then. Under which section 40 clause A, TDS was not deposited. But it will be allowed today. When or why? Because you have deposited the TDS today. Now, the Act itself, under 40 clause A, is allowing you to take deduction in the current year of some past period expense. So in this current example, the rent of past period of which TDS was not deposited then, was 30% disallowed then. That 30% will be allowed in the current year when I deposit this TDS. Perfect, students. I hope this exception to the current year rule is now clear with the present provision that we have discussed. Yes, everybody, is it clear? Good. Excellent. Super. So this is entire 40 clause A. Very good. Very good, everyone. Super. So students, this is entire 40 clause A in total. Complete 40 clause. Super if you all have understood. Now we have completed 40 clause A. Let me go to other restrictions. Some of this we had discussed in the previous class, so it is a revision. So second is 40 capital A bracket 2. Now again, it deals with all the expenses. So any expense which is debited in P&L has the second restriction. So first restriction was TDS. Second restriction is if you are having this transaction with any of the specified persons. Who are specified persons? Your relatives or your associates. The section has defined who will be covered in relatives and associate. Right now, I'm not getting into that. That is there in the module in this section. You can refer, or in the future class when we'll deal section wise, the details will be there. But what is important to be known is that if there is any expenditure in respect of which you have made payment to either your relative or your associate. Why? Because the transaction you have done with your related person or with your associate. The law says we will allow you deduction. We don't have a problem in you doing business with your related parties. The only condition is that we will allow you deduction to the extent the expenditure is within fair limits. So your expenditure up to fair market value will be allowed. But in case your expenses is 125, whereas fair market value is 100, then the difference 25 is disallowed. So whatever is the excess above the fair market value, that is what is disallowed. Students, I hope this is understood. This is clear to everyone. We had discussed this in the previous class also. It is just a revision of that same point. Perfect. Excellent. Next, 49 also we had discussed. As an employer, you are required to do many payments for employees. What are those payments? There are different employee welfare funds. Simplest and the most common example is Provident Fund, where as employer, you have to deposit something out of your pocket, which is also called as employer's contribution. Now, whatever is your contribution to employees welfare fund, it satisfies all the four conditions. Related to business, yes. Current year revenue, yes. Offense, no. So all conditions are satisfied. But 49 has put a restriction that all these employee welfare funds should be approved, should be recognized. If they are unapproved or unrecognized, that will be disallowed. So like you have studied in salary, you have URPF. So if you are making payment to URPF, which is an unrecognized provident fund, I will not give you deduction of employer's contribution. But if the same provident fund, if the same superannuation fund, any of these funds are approved, are recognized, only then you can claim this deduction. Correct? Perfect. Students, now coming to the next interesting restriction. Now first understand why this restriction is put so that you'll understand and appreciate what the restriction is. See, let me give you the practical scenario. Now, year has ended. I draw my trading P&L account. Obviously, you have to assume it is as per income tax, not as per accounts. And I get my PGBP income. Now, when I do this computation after the end of the year, suddenly I realize, oh, this amount is too high. So interestingly, you should be happy that you have earned so much of profit, but you are worried. Why you are worried? Because if this amount is coming as high, that is you are having a very good PGBP income, it is worrying you because to that extent you'll also have to pay high income tax. Now, once people do their computation and they realize that their business income is high, they do some fraudulent manipulations. Why I'm using the word fraudulent? Because they try to show fake expenses which actually never happened. So what simply they will do? They will add some more items on the debit side, or they will simply inflate the values of the existing item on the debit side. And you can understand this. This is simple math. The more debit you are showing, to that extent, your profit will be reduced. And if your PGBP income reduces, by default, the tax liability will reduce. So the point is, you are showing fake expenses. Now, interestingly, if you look from accounting perspective, we debit expenses, right? Credit what? Now, since these are fake expenses, people have no other choice but to pass this type of journal entry for booking fake expenses. So they will debit the respective expense account and they have no choice but to credit cash account. Now, when government realized that such practices are being done to show a lower PGBP income, when actually you have a high PGBP income, but to report a lower income so that your liability also is reduced, government came up with this restriction. Now what it says, if you are having any expense in a day against a single bill exceeding 10,000, so now they have identified a limit 10,000, that if you are showing a payment of an expense against a single bill of rupees exceeding 10,000 in a day, then you should compulsorily do the payment using account pay check, account pay draft, or any of the approved electronic mediums, which includes credit card, debit card, net banking, etc., etc. In short, we want a justifiable proof that these are genuine. So if you are making payment using cash, if you are making payment using bearer check, or even crossed check, and the payment in a day against a single bill exceeds 10,000, we will disallow the whole amount. For example, printing expenses here is 42,000. And again, in the adjustment it is given, it is paid by cross check. What you will do, you will disallow entire 42,000. So entire expense will be disallowed. So this section is simple. In a day against a single bill, if the payment is exceeding 10,000, it should be made only by way of account pay check or draft, or by way of approved electronic or banking channels, the names of which are given here. Only then we will allow that expense. Otherwise, that expense will be fully disallowed. Now, in this section, there are two relaxations. One, if the expense is transport charges. So what are transport charges? We call them as freight, carriage. These are transport charges. If it is transport charges, the limit is slightly increased from 10,000 to 35,000. That is for transport charges up to 35,000 cash is allowed. But if it is also exceeding 35, again, it will be fully disallowed. So the disallowance will be the whole amount, correct? So the entire expense is disallowed. 10,000 is not allowed. So you will not deduct 10,000 and only disallow the excess portion. Entire amount is disallowed. Ishwarya, beta, point is simple. If you are a big company and your daily expenses are exceeding 10,000, which is very much possible. Firstly, the 10,000 is per invoice. So for because you may have multiple invoices in a day. We are talking about per invoice 10,000 limit, and let us say it is also exceeding. So what they are simply saying, make payment by account pay check. In fact, today nobody is even using check. I don't remember when was my last check which I signed. Today we are all using all these approved online mediums: debit card, credit card, UPS, scanning, online payment, using net banking. It has become so easy. In fact, that's why I'm saying I don't even remember when was the last check which I signed or last check which I've even received from any of my client. We don't. Everything is done online, and it is now past more than 5, 6 years we are doing that. And post-COVID, it has become very common. At least up to COVID, people were using selectively because they were having past so many decades of physical transaction comfort. But COVID gave them the comfort of online. So let it be lakhs of rupees, beta, in a day to one person. What the law requires, don't use cash, don't use bearer check, because that is where you can show fake expenses. The moment you are using any of these, the payment is going directly to some person's account and that person becomes traceable. So tomorrow, if they want to cross verify whether your expenses are genuine or not, they know the other party. That is what is the objective. Now, what are the two relaxations? One, for transport charges, the limit has been raised from 10,000 to 35,000. Second, there is a list of few expenses for which they are saying this limit of 10,000 has no relevance. It means this entire restriction is not applicable. It means that for all these payments, amounts paid in lakhs also using cash or bearer or cross check will be allowed. So what it says, Rule 6D says above section restriction is not applicable for the following payments. So these payments, irrespective of the amount, will always be allowed, even if made in cash, bearer check, etc. What is that? You are making payment to government of what? Of indirect taxes. See, there can be no fake in this because whether tax you have paid or not, that can be easily verified with government. Second, you are making payment of interest to bank, LIC, etc. against any of the loans that you have taken from them. Third, you are making a payment or you have to make a payment on a day which falls on a public holiday or on which banks go on strike. Most important is this fourth one. You are buying some natural produce, which can be agricultural produce, forest produce, or any animal husbandry. So these are, let us say, inputs of your business. And you are buying directly from the grower, cultivator, that is farmer. So giving you an example, you are Amul making these milk products. So you are buying milk, correct, which is animal husbandry. So you are buying milk and directly from whom? From the person who is not a trader of milk, but who himself has the cows and buffaloes and who is the grower cultivator of this produce. So the person is himself the originator of this particular item and you are buying from that person directly. So it is a natural item. Second example, let us say you are in the industry of making packaged food for which you require raw fruits. Again, from whom are you buying these raw fruits? You are buying these raw fruits which are agricultural or forest produce directly from the grower. So the person who is having these plantations, you are directly buying from them. Now, in this particular case, the payment which you are making for this natural produce and that also directly to the grower cultivator, it can be made in cash, any amount, the expense would be allowed. Again, some of the track point not covering today just to avoid confusion. So we are only covering the main part. This we again complete or cover in the next class when we take this section again as a revision. So for the time being, what does the restriction says? Any payment in a day against a single bill exceeding 10,000 should only be done by way of account pay, check draft, or through any of these approved mediums. Then it will be allowed. If it is done by cash, bearer check, cross check, the entire amount will be disallowed. First, relaxation, transport expenses like freight, carriage up to 35,000. The limit has been raised from 10 to 35. And for these payments, any amount paid in cash by bearer check will be allowed. Correct? Then we come to 40A7, that is gratuity. Now for this, we had discussed something earlier also. Now that section is this. Now what is the provision for expense of gratuity? Now we know this is a payment to be made to the employees. Earlier, this was covered under the Payment of Gratuity Act. But now, after the notification of those 4 labor codes, it will be covered in one of the labor codes which deals with determination of payment of wages, salary to the employees. So earlier this was as per Payment of Gratuity Act. Now it is part of the labor codes. Fine. Now what does Income Tax Act says? If employee has retired in the current year. So this year the employee is retiring 25-26. Whatever gratuity either you have paid, or let us say it is outstanding to be paid, or it is still a provision, it is fully allowed, no restriction. But where the employee is going to retire in future, so today the employee is working with you, he will retire after 10, 15, 20 years. But as per accounting standards, you are making a provision for gratuity. Now, merely making a provision for a future expense, as we studied earlier also, we do not allow future expenses. So merely making a provision will not give you deduction. But what is the special point given in 40A7? If this provision which you have created is also backed by a deposit made by you in a special fund called as approved gratuity fund. So again, since this is a fund, it has to be approved. This was our condition above also. So your employee will be retiring in future. So this is not a current year expense. It is a future expense. But you have created the provision for that. Plus, you have also deposited the money. So physically, the money is going out of your bank. Not to the employee because he will retire in future, he will pay gratuity in future. But today you are creating a provision, and that provision is actually deposited in approved gratuity fund. If both these conditions are satisfied, I will allow you the deduction. So the provision is straightforward. In case you are having gratuity given in the question, check whether the employee is retiring now or he will retire in future. If the employee is retiring now, whether gratuity is paid or it is given as outstanding or even given as provision, no conditions, it will always be allowed. But if the employee is retiring in future, so this expense becomes a future expense, but you are debiting it now in P&L. Obviously, how? By creating a provision. That provision, if it is actually deposited, it will be allowed. But if it is only provision and not deposited, it will be disallowed. Now coming to the last restriction. Simple one, but just pay attention. What is this last restriction saying? Now, under PGBP head, there are 2 mechanisms of computing PGBP income: cash basis or mercantile basis. So we have a section in the Income Tax Act, section 145, which says that if you are computing PGBP head income or other sources head income, so for both these heads income, this section is giving you a choice. It is giving you an option. You follow cash basis, you follow mercantile basis. Now, if you are computing PGBP income and you have followed cash basis, then all the expenses that are debited to P&L are those which are actually paid during the year. then this section is not required. This section is not required if you are already following cash basis, where by default in P&L, you have only taken those expenses which are paid because that is what is cash basis. But as you know, practically, even in accounts and hence even in PGBP, this is very rare, very rare. Hardly 2 to 3% of businesses will be following cash basis. So remaining 97, 98% are following mercantile basis. Now, if you are following a mercantile method of accounting, so let us call you as a mercantile assessee. Means you are following mercantile basis of accounting, which will be, as I said, 97, 98% of the cases. Now, in this case, what happens? Whatever expenses are debited in P&L may be paid, or it may also include those which are due but not paid. So we call them as outstanding. Now, please understand, students, outstanding expenses are expenses of current year, but they have not yet been paid. Now, the point is, since PGBP and other sources can be computed on mercantile basis as per the option given by section 145, and as I said, 97, 98% people are following this only. So, as per this logic, expenses paid or outstanding both should be allowed as deduction, and they are allowed as deduction except for these 7 items. For these 7 items, the condition is we will allow them only if it is paid. Now you'll say, sir, then what is the use of mercantile then? So the answer is, we are giving you an extended period that for getting deduction of these 7 expenses, or first I'll say 6, because for 7th one, there is a different condition. So for getting deduction of these 6 expenses, the condition put is that either you pay up to 31st March, it is great. Even if it is not paid up to 31st March, means it is shown as outstanding as on 31st March. So the books are closed on 31st March. So as on 31st March, it is outstanding. But if you go and pay this amount to the respective supplier up to the due date of filing your returns under 139(1), which we saw above, 30th November, 31st October, 31st July, depending upon different assesses, different due dates are given. So if you if you pay these expenses, means they are no more outstanding. So maybe in the books, as on 31st March, they may be appearing as outstanding because they were outstanding on 31st March, but you have sufficient time up to due date of filing of your returns. If you pay them up to the due date of filing of returns, I will allow you deduction. But if these remain outstanding even as on the due date of filing returns, I will disallow them. So for these expenses, I'm talking about for 6, the condition is, the restriction is, for mercantile assessees, they should actually pay these expenses. If paid during the financial year, best. Even if not, even if it is outstanding as on last date, still paid before your due date of return filing. If you pay it, you get deduction. If you don't pay it, for this year, the deduction is disallowed. And yes, logically, it will be allowed when in the year in which you actually pay these. So that is the next part. So in the current year, it is disallowed. In the future, whenever you pay it, it will be allowed, or it is other way around. This amount is pertaining to some earlier period. In that period, it was disallowed. Why? Because you did not pay it then. But in the current year, you are paying that amount of some past year. So we will allow you deduction of that past year expense in the current year because you have paid it. Now, what are these 6 expenses for which this payment condition applies? First, payment to government of indirect taxes, interest loans from bank financial institutions, bonus commission to employees or leave salary to employees, employers' contribution to various funds, and obviously these have to be approved and recognized because otherwise they are anyways disallowed. And if you have taken any railway assets on hire, you are using railway assets, then you should have paid the amount to Indian Railways for using the railway assets. So these 6 expenses, condition is these expenses you should pay at least up to the return filing. So the position is either you pay it in the year itself during the previous year, best. If not, at least before your return filing date, go and pay them. If you do this, you get the deduction in this year. If not, for the time being, we will disallow them. And we will allow it in the future year in which you actually pay these expenses. Now, this section is indirectly, firstly, it is disallowing current year expense, but at the same time, it is allowing you past year expense. So again, coming back to our same condition, what is the same condition? We allow deduction only of current year expense, but what is the exception to this? The exception is the expenses are covered in 43B, the present list which we are seeing, and they pertain to some earlier period. So let us say, I give you an example, bank interest. Again, this is given as an additional adjustment here. So here you have ninth adjustment. Bank interest of previous year 21-22 rupees 40,000 paid on 19th December 25. Now this expenses of 21-22 of some past period, but it is paid in the current year. So first thing which you have to understand, imply from this, that this amount was disallowed in this year. So 40,000 was completely disallowed. Why? Because bank interest is covered in 43B list. So bank interest is one of those 6 expenses which is covered in 43B list. And since it was not paid at all in that year, even up to the due date of filing that year's return, it would have been disallowed. This is what you have to imply. Now it is paid in the current financial year. That is in our previous year, 25-26. So when you are doing computation of PY 25-26, you will allow this 40,000 as deduction. So again, from this additional adjustment, you will decide that, okay, this 40,000 is now allowed in the current financial year, though it pertains to some old period, that is financial year 21-22. Students, I hope this is very, very clear to you all. This is what is the restriction in 43B. Anybody? Any questions? Super. Super. Very good. Very good. Excellent. Super. Super. Now in this list, the 7th expense has slightly different condition. Now you are making payment to a MSME. MSME is medium or small enterprise. Now if you are making payment to medium or small enterprise, I request technical person to please share the WhatsApp link, because some students are asking for our WhatsApp group link. So technical support, can you please share the WhatsApp group link here? Some students want it. No, sir, the students are asking. So what should we tell them? Please, please. So I'm still there 5 minutes. If you get the confirmation, please post it here. Okay. So students, notice this seventh expense. In this 43B list, this seventh expense, which is very recently added, is dealing with where you have purchased any goods or service from such a business entity which is registered as a MSME, small and medium enterprise. Now, if the entity is registered as a small and medium enterprise, then there is a special act applicable to them, MSME Development Act. Now, in this act, section 15 has given its own condition. What is this condition? MSME Act section 15 says that if there is no written agreement between you and MSME about in what time the payment should be done, then you should have made the payment maximum in 45 days, right? Maximum. Otherwise, it has to be 15 days. So in short, you have to check the agreement. If agreement is allowing still maximum 45 days, so agreement cannot say 6 months. Even if agreement saying a higher period, maximum will be 45 days. And if agreement is not specifying anything, then within 15 days, you have to make the payment. Now, importantly, where the payment is to MSME, PGBP head section 43B has covered this in this condition that the payment should be made. But what it is saying, the payment should be made as per MSME Act. That is, if nothing is specified within 15 days, or if specified, but it cannot exceed 45 days, so maximum 45 days. Now, if you do not pay this amount to MSME within this period, then obviously we will disallow the deduction now, and we will allow it in that previous year in which you have paid it. What is very important, why I took this separately, because here the extra time which is allowed for the first 6 expense, what is the time allowed? Up to the due date of filing return under 139(1) is not applicable. Because see, the due date is 31st of July, 31st of October, 30th of November, which is much beyond this 45 days time limit. So if you are exceeding this 45 days time limit, which is the maximum time allowed, you will not get the deduction in this year. Yes, you'll get the deduction, but in the previous year in which the payment is made. So that is why this 7th point is covered separately. So for 7th point, the payment should be made within the due date of the MSME Development Act and not up to the due date of filing returns, which is allowed for the first 6 expenses. So 43B requires that these 7 expenses should actually be paid for getting the deduction, out of which for first 6, you should pay it maximum up to the due date of filing returns. And for 7th, as per the MSME Development Act, maximum time limit allowed there. Now, if any of these payments are not done as per the timeline allowed, then in the current year, it will be disallowed. But in that financial year or previous year in which it is paid, it will get allowed. So this is what is restriction of 43B. And with this, we have also completed 75% of PGBP provisions. We have covered rather everything in PGBP when it comes to the allowability or disallowability. Yes. Now, what is to be done in future sessions is now we'll go to each of these sections in detail, especially those sections which have some specific deductions or specific conditions. But right now, you are standing at that point that up till this stage, you should now be able to handle the sums of PGBP. Yes, for few adjustments, since certain specific sections are yet to be understood, studied, that will take time. But otherwise, you can now approach the sums. So my request now, students, is that you should revise this whole PGBP up to section 43B, study everything. Yes, in between few sections, you may not fully understand because there are some technicals. That is okay, that we are going to cover. But what I want is now you start even approaching the module sums. Why I am saying this? Because in the next class, when I'll come back and when I'll revise, See, all this revision is theory until and unless you do it with a practical sum. Like I already took one simple practical sum, and now when I'm explaining this provision, I'm referring to that practical sum. So you are understanding these very simply. Why you are able to understand this? Because I'm linking it with practical. So these all conditions are technical, are theoretical, but if you do it with practical sums, maybe initially you may get some hiccups because it is something technical, but with more and more practice, you will master. And also, theoretically, you will be able to remember and recall it much easier. So this is the best way of even learning these sections, that is doing it with practical. So my request is you can treat this as your homework. You have to study these sections from your module and you have to start solving module sums. Now in module, you have sums given under each section. Don't solve them because we are yet to deal with specific sections in detail. You have to go to the end of the module where comprehensive sums are given, where P&L and the adjustments are given. Start solving those sums. And when you are solving, for every provision, come back to the section, read the section again in the light of that question. So when you do it with a practical sum, understanding will be much better, stronger, and most important, you will be able to retain it in your minds and recall it whenever required. Fine, students. So this is your entire PGBP. Yes, few sections are left, but 75% of sections are being completed and the sections required for solving practicals are majorly completed. Anybody having any specific questions, doubts, please put it across. Yes, students, any questions, any doubts with any provision, any point that we discussed, that we studied? Sir, if MSME not paid in time, then not allowed in current year, not in future. No, in future it will be allowed. So 43B is only disallowing in the current year. In future, whenever it is paid by the Ashlesha, it will be allowed, even for MSME. Yes, I agree to this, Neeraj. I also have this question that in CMA class, the network was lagging. So maybe the network is liking PGBP more. Sir, some TDS deduct too important. I did not get your point, Nagarajan. But please elaborate whatever you say because if you are giving very small some inputs, it is difficult. Okay. So Virali is asking, sir, if we have material, can you tell us which problems we should solve? Then give me a second. Mm, I'll just see the module and tell you which illustration number onwards you have to solve. See, the provisions and I think up to illustration. See, at the end of the PGBP chapter, you have let us recapitulate, like how you have in all the other topics. So here also you have let us recapitulate. I'll just reshare my screen. So see, after the entire provisions or the topic is over, you have this let us recapitulate here. Okay. Now you have to go beyond that. Beyond let us recapitulate. So here all sections are given in short. Now after this, you have these questions, correct? You skip question 1 because it is exclusively on computation of depreciation, which we are yet to study. So you skip question 1. 2, you skip. Because see, again, these first initial questions are specifically with relation to. So you can start from question 3. Correct, Virali and all others. So from question 3, you can start solving, students. Correct? 3 onwards, you start solving. I don't say it will be easy because again, you will be doing it for the very first time. But yes, with more and more practice, you will master it. Perfect. Yes, Kuldeep, tax audit we are yet to study. Yes, Tanisha, it's time to revise. It's time to take this ahead at your end. So my role as teacher is over. Your role starts from now, which is the most challenging part because now you have to understand it by yourself, but it is going to be fun. See, that is the main challenge. That is the main fun. Doing something which is unreal, doing something which is not so easy. That is the fun. Yes,
Sir,
Nagaraja, please ask your question.
your voice audible, sir.
You are audible, beta. Please tell me.
Sir, in some cases, TDS deductors under section 194H, 194J, example, commission paid in excess 50,000. Is turnover is also important, sir. Turnover not exceed, no, not exceeding immediately preceding previous year. It,
Continue.
for section 40A not
Liable
allowed,
for
sir.
TDS.
Sir,
So what is your question? Please complete your question, beta. I'm understanding what you're asking.
section 40A, some cases not allowed, sir.
See, beta, I've already mentioned, you will check 40A only if TDS is applicable to you. So if you remember, if you recall my notes, in 40A, my first sentence was where TDS is applicable. Expenses on which TDS is applicable. See, can you see this? See, on which TDS is applicable. So whether TDS is applicable or not is dependent upon last year's turnover, dependent upon who you are. There are so many things. But all those things, better you study in the TDS chapter. You have a separate chapter on TDS where you will study the names of different expenses. You will study all these conditions. Here in PGBP sums, that would be given. Exceptionally, there will be 1 or 2 adjustment where you have to first go to TDS chapter. But anyways, by the time you go for your final exams, you will have studied the TDS chapter. So you will be able to even determine that. But here for the time being, that would be given in the question. So if they are saying TDS is not deducted, it means they are indirectly giving you that hint that you are liable for TDS. Are you getting my point?
Yes, sir.
But still you are correct. For determining TDS, there would be questions where you have to check the turnover and everything, but that is yet to be taught to you. Why? Because that is part of TDS. Correct, beta?
Sir, that mean some cases 40A not attracted.
Correct. So beta, see, if TDS is not applicable, then 48 is a 40 clause A is also not attracted. Na? So for 40 clause A being attracted, again, see, on which TDS is applicable. If TDS is not applicable, 40 clause A entirely is not applicable to you. Correct?
Yes, sir.
So you are required to deduct TDS first, then only you have to check whether deducted in time, whether deposited in time. If TDS itself is not applicable, no need to apply 40 clause A. Correct?
Yes.
Okay. Yes, Aditya.
Sir, I am audible, sir.
You are audible, but
Hello,
please tell.
sir. In P&L account, both sides they give salary. How we have to handle, sir? Both sides
Sorry,
salary
I
gives.
could not understand. In P&L?
Sir, in P&L account, salary gives both sides, sir. Both.
So beta, when they are giving salary on the credit side, what it represents your salary income. Salary income will be covered under the head salary. Na? See
Yes, sir.
here,
Yes, sir.
can you see this? In
Yes,
my
sir.
P&L also I have shown, but this is with salary which you have earned. So let us say you are in part-time employment, so you are getting salary. So it is not part
Yes,
of
sir.
PGBP. Why? Because
Mm.
it goes to salary head. But when salary is given on debit side, it is your salary paid to your business employees. So that is part of PGBP. So there are two different points applicable. So debit side salary is part of PGBP. Credit side salary is not part of PGBP. It is of salary head. Correct, beta?
So, sir, when debit side comes, it may be part of PGBP.
Correct, because see, salary given on debit side, see, any expense given on P&L debit side, the general rule is that expense belongs to business until unless it is specifically covered in any other head. Now,
Yes, sir. Yes, sir.
salary expense is salary paid to your employees. So it is part of business only, na beta?
Mm.
Correct?
Correct, sir. Correct.
Salary on the debit side is not part of salary head. Salary on the credit side is part of salary head. Right?
Yes, sir. Okay, thank you, sir.
Most welcome. Any other doubts, students?
Sir, one more question, sir.
Please go ahead.
Sir, uh, so you said that section 40A,
Hmm.
point one not complied with disallowed shall be for a payment to a resident in India,
Hmm.
30% percentage only disallowed.
Hmm.
In the 30% disallowed, remaining 70% portion,
Allowed. So when I'm saying 30% disallowed, it means 70% is allowed, na? So the
70%
problem,
added to PGBP.
sorry,
70% remaining portion added to PGBP.
no, beta, 30% is added because you have debited this whole expense in your P&L, correct? It means whole expense is treated as a deduction by accounts, correct, na?
So 30% disallowed means net profit gain, sir.
See, 30% disallowed means what? I will allow expense up to 70%, 30% I will not allow, correct?
Huh.
Correct, na?
Yes, sir.
So what is not allowed is what will be increasing the profit. See, this expense, entire 100 rupees is debited in your P&L, correct?
Yes.
So it means account has claimed the deduction of entire 100 rupees, out of which I am saying 30%, that is 30 rupees, is not allowed by PGBP. So while computing PGBP profit, you will add 30 rupees.
Oh, okay, sir.
Correct?
I am think that 70% added to PGBP.
No, no, beta. See, when you are doing reconciliation, you'll add 30%.
Okay, okay, sir.
Yes.
Clear, clear, sir.
Yes, students, any further questions? No questions? Yes, Aditya.
Sir, one last question, sir.
Please tell me.
Sir, in the 30% disallowed, can we add it to credit side or debit side, sir?
Beta, there is no debit or credit side.
Mm.
There is no debit or credit side, beta. It is the reconciliation format where we add less. Debit and credit is in accounts. PGBP, how we
Yes,
are
sir.
doing? We are doing it as reconciliation, add less. So when we are
Yes, sir.
saying
Yes,
add it
sir.
in that format, now see, this is our PGBP working. How do we find out PGBP income? We find out by preparing this reconciliation statement. So it will be added. Now, so add means simply add. So take net profit of accounts and add in that. There is
Yes,
no
sir. Yes,
debit or
sir.
correct.
Correct, sir. Correct. Okay,
Perfect.
sir.
Perfect. Any further questions, students? Great. So we conclude our session. Please revise, please solve. That will help you in the next class. Good day, everyone. Thank you. Please take care. Good day.